Warren Buffett's Berkshire Hathaway portfolio has long served as a beacon for value investors seeking quality companies with durable competitive advantages. Warren Buffett, widely regarded as one of the greatest investors of all time, has curated Berkshire Hathaway's portfolio with an unwavering commitment to the principles of value investing, a discipline that prioritizes the intrinsic worth of a business over temporary market sentiments. For decades, this portfolio has functioned not just as a collection of stocks, but as a living guidebook for investors who seek companies with time-tested profitability, prudent capital allocation, and enduring economic moats, qualities that safeguard a business from competitive erosion over the long haul. As we move through 2025, several of Berkshire's holdings stand out as attractive investments, combining strong fundamentals with reasonable valuations despite the broader market's continued focus on technology and growth stocks. In the current landscape of 2025, where investor attention remains heavily skewed toward fast-scaling tech firms and momentum-driven growth narratives, Berkshire's top holdings provide a refreshing counterbalance. Businesses with real earnings, stable cash flows, and resilient franchises. These companies are not riding the wave of hype. They are grounded in operational excellence and long-term discipline. Their valuations, often overlooked amid market euphoria, reflect not speculative potential, but measurable strength and sustainability, presenting savvy investors with rare opportunities for rational entry. This analysis examines 5 of the most promising Berkshire Hathaway positions that offer investors strong business models, competitive moats, and potential for long-term capital appreciation. In this exploration, we will dissect 5 core investments held by Berkshire Hathaway, companies that exemplify Buffett's deep-rooted preference for predictability, quality, and durability. Each firm demonstrates a robust business model, a defensible market position, and the capacity to generate excess returns over time. These are not merely stocks in a portfolio. They are entire ecosystems built around strategic dominance, prudent management, and enduring consumer relevance. Each selection represents a company that aligns with Buffett's investment philosophy and appears well-positioned for success in today's evolving economic landscape. Each of these companies reflects a critical alignment with Buffett's timeless principles: buying wonderful businesses at fair prices, prioritizing long-term value over short-term volatility, and investing only in firms whose future earnings can be reasonably projected. In a world where technological disruption, inflationary forces, and global uncertainty coexist, these holdings shine not through novelty, but through resilience, discipline, and quiet compounding, the very essence of the Buffett way. 5 Best Warren Buffett Stocks to Buy and Hold in 2025, based on Berkshire Hathaway's 13F, as of June 30, 2024, and Form 4 filings. Warren Buffett is not a speculator. He is a business owner in the public markets. His stock picks are not short-term plays, but long-term commitments to superior companies, those with enduring moats, trustworthy management, and the ability to grow shareholder value year after year. In 2025, with markets still digesting high interest rates, shifting global power dynamics, and a digital revolution, these 5 core holdings reflect not just Buffett's style, but timeless investing wisdom. The top 5 stocks in the Berkshire Hathaway portfolio are: 1. Bank of America. 2. Coca-Cola. 3. Apple. 4. Occidental Petroleum. 5. Moody's Corp. Final thought: why buy and hold these 5 in 2025? These aren't just 5 tickers, they are 5 investment case studies in Buffett's playbook. Durability: each has a competitive moat. Simplicity: he understands the business model. Cash flow: they generate tons of free cash. Capital allocation: they reinvest wisely or return cash through buybacks, dividends. Management: Buffett only partners with those he trusts. Holding these companies in 2025 means aligning your portfolio with a $1 trillion empire's highest conviction ideas. In volatile times, that's not just wise, it's a strategy built to last. Now next, we will know about each company one by one. Why is Warren Buffett known as one of the best investors? Warren Buffett's reputation as one of the greatest investors in history is not merely a product of wealth accumulation. It's a consequence of how he created that wealth, the principles he adhered to, and the consistency with which he practiced them over decades. 1. A lifelong commitment. Early start, enduring focus. Buffett started investing when he was 10 years old and took the helm at Berkshire Hathaway when he was 35. Depth insight. Very few people begin their life's work with such early clarity. By age 10, Buffett wasn't merely dabbling, he was cultivating an investor's mindset, studying business reports, and placing real money on his judgments. This wasn't chance, it was intention. What it shows? Discipline, vision, and the ability to delay gratification. From a young age, Buffett understood that investing wasn't a game of speed, it was a game of time and wisdom. 2. The transformation of Berkshire Hathaway. From dying textile to financial empire. At the time, Berkshire was a textile manufacturer. Today, in Buffett's 94th year, Berkshire Hathaway is a diversified holding company, and S&P 500 constituent worth nearly $1 trillion. Depth insight. The genius of Buffett was not in chasing trends or making wild bets, but in seeing intrinsic value where others saw decay. Berkshire Hathaway was a failing textile mill. Yet Buffett didn't simply walk away, he repurposed it, slowly transforming it into a capital allocation machine. What it reveals? True investing is not just buying and selling, it is building, nurturing, and reimagining assets. Buffett saw businesses not as stock tickers, but as living organisms with cash flows, people, and futures. 3. His shareholder. Letters, more than reporting, a masterclass in thought process. He has documented his time at Berkshire with annual letters to the company's shareholders. Depth insight. These letters are not merely reports, they are intellectual legacies. Buffett doesn't just talk numbers. He explains why decisions were made, how mistakes occurred, and what principles guided the year's actions. What it means? The transparency and humility in these letters reflect a rare kind of integrity, one that sees shareholders not as spectators, but as partners. Buffett teaches as he invests. His clarity becomes a compass for others. 4. Timeless wisdom. Encapsulated in simple words. Some of Buffett's most memorable quotes have come from these letters. Depth insight. Buffett's quotes aren't just witty. They carry entire investment philosophies distilled into a sentence. For instance, be fearful when others are greedy, and greedy when others are fearful. This isn't just advice. It's a framework for contrarian thinking rooted in emotional discipline. What this shows: great investors manage emotions better than they manage portfolios. Buffett's quotes are reminders that investing is as much psychological as it is financial. 5. Long-term performance. Consistent, not flashy, but monumental. Between 1965 and 2023, Berkshire Hathaway grew at a compound annual rate of 19.8%, nearly double the S&P 500's 10.2%. Depth insight. The true magic lies not in a single year of outperformance, but in the compounding of nearly 60 years of intelligent decisions. Doubling the return of the market sounds impressive, but over time, it creates a seismic wealth gap. Mathematical truth. A $1,000 investment in the S&P 500 in 1965 would grow to $280,000. The same in Berkshire, over $40 million. This is the compound effect, simple decisions, consistently applied over very long periods. 6. Longevity matters more than high scores. While other investors have beaten the market by wider margins, none have done it for as long as Buffett has. Depth insight. Many investors have hot streaks. Some have brilliant insights. But Buffett's strength is not speed. It's sustainability. His consistency over 6 decades demonstrates that enduring greatness comes not from luck or a few big wins, but from character, judgment, and patience. What it proves: investing greatness isn't about beating others in the short term. It's about outlasting them with less risk, fewer mistakes, and more discipline. 7. The simplicity that hides great power. He has proven repeatedly that investors don't have to trade heavily or time the market to create wealth. Depth insight. Most people think investing requires complexity, speed, and constant movement. Buffett shattered that myth. His style, low turnover, deep research, long holding periods, teaches us that the real edge lies in inaction when others are reactive. Mental model. Buffett is the embodiment of deliberate calm in a world addicted to noise. He doesn't react to every crisis, he responds with perspective. 8. The core of his strategy. Buy wonderful businesses at reasonable prices. Buy good companies at value prices and hold them indefinitely. Depth insight. Buffett focuses on companies with durable competitive advantages. Moats that protect profits, brand equity, pricing power, and loyal customer bases. He waits for them to be undervalued, then holds through decades. What this reveals: he invests in economic engines, not stock charts. He seeks quality over hype, substance over story. His patience becomes his advantage. 9. The power of time and compounding. In this strategy, compounding does the heavy lifting to create outsized gains over time. Depth insight compounding is the most powerful force in finance, and Buffett uses it like a master artisan. His genius lies in realizing that time is the most critical variable in wealth creation, not timing. Life lesson: what matters most is not what you earn in a single year, but what your money earns while you sleep. For decades, Buffett's wealth didn't explode in his 30s. It flourished in his 60s, 70s, 80s, and beyond. That's the magic of compound interest. Conclusion: what makes Buffett truly great? Warren Buffett isn't just a great investor because he's rich. He's great because he showed the world that rationality, patience, simplicity, and integrity can consistently outperform the frenzy of speculation. His career is proof that capitalism, when practiced with ethics and long-term thinking, can be both immensely profitable and morally admirable. Buffett turned investing into a philosophy, a discipline, and an art. That is why he is not just one of the richest men on earth. He is one of the wisest. Warren Buffett's investing philosophy. A deep dive into the mind of a master capital allocator. The mandate of a value creator. Warren Buffett, often revered as the Oracle of Omaha, is far more than a billionaire investor. He is the chief architect of value creation at Berkshire Hathaway, the colossal holding company he has nurtured for decades. His role is not just to preserve wealth, but to grow it responsibly for the shareholders who entrust him with their capital. This responsibility is not taken lightly. Every dollar Berkshire invests must pass a rigorous test of prudence, patience, and performance. Buffett's preferred route to delivering shareholder value is strategic ownership, owning companies either in whole or in part. When the opportunity arises, he will buy a company outright and let it flourish under Berkshire's decentralized management philosophy. But in the public markets, where partial ownership is possible through stock purchases, Buffett is no less disciplined. He deploys capital where he sees enduring value, not fleeting trends. Why investors follow Buffett's every move. Buffett's stock purchases are never impulsive or speculative. They are the result of a highly structured mental model. one built over decades. Investors around the world study his trades because they reflect careful analysis, patience, and a clear signal of what Buffett considers undervalued. His portfolio movements aren't just financial decisions, they are lessons. When he buys, it signals confidence in a business's long-term fundamentals. When he sells, it may suggest that the business no longer meets his strict standards of quality or value. The foundation understanding Buffett's strategy. At the core of Buffett's investment style is a time-tested framework called value investing, a discipline he inherited from his mentor, Benjamin Graham, but refined into a modern, more pragmatic version. Buffett looks for companies that satisfy three main pillars: proven business models. He avoids unproven startups or speculative ventures. Instead, he prefers companies that have a long track record of profitability, scalability, and operational consistency. Durable competitive advantages or moats. This is the key differentiator. Whether it's brand strength, cost advantage, network effects, or regulatory barriers, Buffett wants companies that can protect their profits from competition for a long time. Competent and ethical management. He invests in leaders who think like owners, not just managers. Integrity, capital discipline, and the ability to allocate resources wisely are essential. And most importantly, Buffett doesn't chase trends. He holds a firm belief: no one can predict short-term market movements. Instead, he commits to the timeless principle of holding great businesses for as long as they remain great. The math behind the magic, intrinsic value, and margin of safety. Buffett's decisions are rooted in a concept called intrinsic value, the present value of all future cash flows a company is expected to generate. He estimates this value and compares it to the current stock price to assess whether the company is trading at a discount. But he doesn't stop there. He builds in a margin of safety, a buffer to protect against errors in judgment, unpredictable events, or changes in the business environment. For example, if he calculates that a company's intrinsic value is $100 per share, he might only be willing to pay $65. This 35% discount is not greed. It's discipline. It protects capital and magnifies returns when the market eventually corrects the mispricing. Here's the nuance: he's not looking for cheap stocks. He's looking for high-quality stocks at undervalued prices. There's a critical difference between value and low price. Opportunistic yet disciplined. When Buffett buys, Buffett waits for mispriced opportunities, often during times of panic or dislocation in the markets. When others are fearful, he becomes greedy, but only if the fundamentals of a company remain intact. This contrarian mindset is most visible when markets crash or sentiment turns negative. During such times, Berkshire tends to increase its buying activity. That's when prices are low and the margin of safety is highest. Buffett understands that volatility is not risk, it is opportunity. True risk, in his view, is permanent loss of capital. And that is precisely what the margin of safety guards against. The essence of Buffett's investment checklist. Here's how Buffett filters his investment ideas. 1. Do I understand the business? If he can't explain how the company makes money, he doesn't invest. This is known as staying within one's circle of competence. 2. Does the company have a durable competitive advantage? If yes, that means it can continue to earn high returns on capital for many years. 3. Is the management trustworthy and rational? He studies how management allocates capital, communicates with shareholders, and handles adversity. 4. Is the stock trading below intrinsic value with a margin of safety? Only if this final condition is met will Buffett consider investing, and he is content to wait, sometimes for years, until this condition aligns. Why it works. Timeless principles in a changing world. Buffett's strategy has endured through bull and bear markets, recessions, and booms, not because it's flashy or trend-following, but because it's rooted in timeless financial principles. In an age of high-frequency trading, artificial intelligence, and speculative bubbles, Buffett stands out by doing less, but doing it better. He focuses on businesses that generate consistent free cash flow, have pricing power, the ability to raise prices without losing customers, can thrive in both good and bad economies, have strong brand loyalty, require low capital to grow. This combination allows him to compound capital steadily over time, the ultimate goal of long-term investing. Conclusion: the takeaway for investors. Warren Buffett's genius lies not in complexity, but in clarity. He has crafted an investment approach that balances discipline with opportunism, patience with decisiveness, and caution with conviction. For Buffett, investing is not a game of excitement. It's a business of allocating capital to its highest and best use. What can we learn from him? Understand what you invest in, wait for the right price, and never compromise on quality. Avoid speculation and short-term thinking. Trust in time, compounding, and the power of discipline. Seek great businesses, not just good stocks. In a world obsessed with speed, Buffett teaches us the value of slowness, thoughtfulness, and enduring excellence. That is why, decade after decade, he remains one of the most respected and emulated investors of all time. How these stock picks were chosen. A deep dive into the selection framework. This selection process focused on Berkshire Hathaway's current portfolio holdings. The foundation of this stock-picking effort begins with one of the most scrutinized portfolios in the financial world, Berkshire Hathaway's. Instead of starting from scratch or relying on speculative ideas, the process deliberately examines the publicly disclosed holdings of Warren Buffett's investment vehicle. These holdings represent businesses that have already passed through Buffett's famously rigorous screening process. That means they've likely been evaluated for factors like long-term sustainability, quality of management, and financial conservatism. By focusing on this universe, we filter out thousands of lower-quality or unproven companies, immediately narrowing attention to those that meet Berkshire's high bar. Analyzing each position based on fundamental strength, market position, and alignment with Buffett's investment principles. Once the universe of stocks is defined, the next step involves fundamental analysis, assessing the financial health of each business. This means going beyond stock prices to evaluate what Buffett calls the intrinsic value, what a company is truly worth based on its ability to generate cash flows over time. The analysis includes balance sheet strength. Example, manageable debt, ample liquidity. Income statement, quality. Example, consistent, revenue and profit growth and cash flow statement clarity. Example, real, recurring free cash flows. Next, each company's competitive position in its industry is evaluated. This reflects Buffett's emphasis on a moat, a sustainable competitive advantage that protects a company's profits from rivals. Companies with strong brands, network effects, cost advantages, or high customer switching costs are particularly attractive. Finally, the alignment with Buffett's core principles, such as simplicity, predictability, ethical management, and long-term value creation, acts as a filter. If a company strays too far from these ideals, example unproven tech startups or highly cyclical businesses, it is likely deprioritized. I prioritized companies with strong cash flows, reasonable valuations, and durable competitive advantages. This line summarizes Buffett's most time-tested investing traits. Strong cash flows. Buffett often says cash is to a business what oxygen is to the body. It doesn't matter how flashy a business appears if it cannot generate real, usable cash after capital expenditures. This is a test of economic productivity. Reasonable valuations. Even great businesses become risky investments if bought at too high a price. Buffett avoids overpaying, even for the best companies. Metrics like price-to-earnings, PE, price-to-free cash flow, and discounted cash flow, DCF estimates are essential in gauging whether a stock is attractively priced. Durable competitive advantages. Here lies the moat again. A business must not just be good today, It must have identifiable characteristics, brand power, economies of scale, patents, etc., that protect its profitability 5, 10, or even 20 years into the future. Special attention was paid to recent business performance, management effectiveness, and potential catalysts for future growth. This stage incorporates dynamic factors, recognizing that even the best companies evolve over time. The analysis asks, recent business performance. How is the company handling today's challenges? Inflation, interest rates, supply chains, etc. Are margins stable? Is revenue growing faster than competitors? Management effectiveness. Buffett famously says, buy into a business that's so good, an idiot could run it, because sooner or later, one will. But he still prefers great leaders who are rational capital allocators. Those who reinvest wisely, avoid excessive risk, and act with integrity. Earnings calls, shareholder letters, and past decisions help judge this. Catalysts for future growth. Even Buffett watches for potential tailwinds, like new markets, product expansions, regulatory changes, or macroeconomic shifts that could accelerate a company's earnings power without requiring large capital outlays. Each selected company was evaluated against current market conditions and sector-specific challenges. No business operates in a vacuum. That's why the chosen companies are benchmarked against real-time external environments. This includes macroeconomic factors, interest rate trends, inflation pressures, GDP forecasts, regulatory landscapes, especially important for sectors like finance, energy, and healthcare. Consumer sentiment shifts are customer preferences evolving. Competitive intensity are new entrants disrupting the industry. By understanding the external pressures a company faces, we gain insight into its resilience and adaptability. I considered factors such as return on equity, debt levels, and free cash flow generation. These financial ratios reflect Buffett's core focus on efficiency and risk. Return on equity (ROE) measures how effectively a company turns shareholders' equity into profits. A consistently high ROE indicates smart management and a valuable business model. Debt levels. Buffett avoids companies with excessive leverage. High debt magnifies risk and can destroy shareholder value in downturns. The focus here is on healthy debt-to-equity ratios and interest coverage. Free cash flow generation, the lifeblood of business. This is the cash left after maintaining and growing operations, used for dividends, buybacks, or reinvestment. A strong free cash flow profile is crucial for long-term compounding. Additionally, I examined each company's ability to maintain or grow market share in their respective industries while delivering consistent returns to shareholders. Finally, the goal isn't just static excellence, it's dynamic dominance. A good investment candidate is not only surviving in its sector, but steadily increasing its influence. This involves sustained pricing power. Can the company raise prices without losing customers? Innovative adaptability. Can it evolve with industry trends? Customer loyalty and brand strength. Does it have repeatable demand? At the same time, it must reward shareholders consistently through dividends, buybacks, or capital appreciation without sacrificing future growth. Summary. 1. Start by looking at companies already vetted by Buffett. A pre-approved list of quality. 2. Evaluate them based on financial strength, competitive positioning, and Buffett's principles. 3. Prioritize companies that are cash-rich, fairly priced, and competitively protected. 4. Consider recent performance and whether management is intelligent and disciplined. 5. Factor in external economic conditions and challenges in each sector. 6. Use financial metrics like ROE, debt levels, and free cash flow to judge health and sustainability. 7. Ensure each business can defend and grow its market share while rewarding shareholders reliably. Why Bank of America, BAC, stock is a top choice. A deep dive business and investment analysis. 1. Business overview, the backbone of modern banking. Bank of America is not merely a traditional bank, it is a multifaceted financial powerhouse that touches nearly every segment of the U.S. economy. With over 66 million retail and small business clients and nearly 4,000 retail branches, Bank of America commands a vast physical presence. However, the true strength of its current operations lies in the digital transformation it has undertaken over the last decade. Key pillars of its business model: retail and consumer banking, 35% of revenue checking, savings, mortgages, auto loans, credit cards, etc. Wealth and investment management, 20% of revenue, Merrill Wealth Advisory and private bank services, global banking and investment banking, tied into 25% of revenue, corporate lending, advisory, underwriting, M&A, trading desks, digital banking. Over 90% of transactions now occur digitally, marking a paradigm shift in how financial services are delivered. This diversified structure insulates Bank of America from sector-specific volatility. When consumer credit tightens, wealth and investment management often continue to grow. When corporate advisory slows, retail deposit inflows tend to remain strong. 2. The digital revolution. Technology as a profit catalyst. Bank of America has strategically invested more than $3.5 billion annually in technology, not just to modernize, but to redefine banking efficiency. These investments are not superficial. They are core to profitability and customer retention. Digital penetration and impact. 75% plus of consumer interactions are now digital. Mobile user growth at 10% per year, indicating increasing customer reliance on mobile platforms. Cost savings. Every digital transaction costs 20% less than its in-person counterpart. Customer satisfaction. Scores exceed 80%, indicating that digital doesn't compromise service quality. This digital edge means scalability without proportionate cost increases. Unlike banks needing more branches to expand, Bank of America can grow with a leaner footprint. 3. Financial strength and balance sheet. Resilience. Bank of America operates with conservative financial discipline, a vital trait in volatile economic climates. Capital and liquidity metrics. Tier 1 capital ratio, 11%, significantly above regulatory minimums, ensuring cushion during crises. Loan-to-deposit ratio. 170% indicates liquidity strength. The bank lends conservatively, holding ample deposits. Stress test results. Bank of America has passed the Fed's stringent stress tests, confirming it can maintain dividends even in deep recessions. Profitability metrics. Return on equity, ROE. 15% healthy return for a large-cap bank, signaling efficient capital use. Net interest income margins. 2.5%. Bank of America profits well from the spread between lending and deposit rates, which widens in high-rate environments. Efficiency ratio, 60%. This means operating expenses consume less than 60% of revenue, a sign of strong operational control. 4. Why Bank of America is a top-tier investment pick. Warren Buffett's Berkshire Hathaway holds over $35 billion worth of Bank of America stock, making it the largest financial sector position in his portfolio. This endorsement speaks volumes about the bank's long-term value proposition. Investment merits. Diversified revenue. Bank of America doesn't depend on one stream. If lending slows, wealth management or investment banking can still drive income. Interest rate tailwinds. As the Fed holds rates above 5%, Bank of America's net interest margins expand, leading to stronger income from lending operations. Digital transformation reduces costs, improves margins, and enhances customer stickiness, building a competitive moat. Consistent dividend payouts. Backed by stress test results, Bank of America can sustain shareholder returns even during downturns. Fee-based income stability. Wealth management, with $3 trillion in client balances, generates over $5 billion in annual revenue, largely unaffected by interest rate cycles. Strategic positioning in a dynamic market. Bank of America is positioned to thrive across economic cycles. In expansionary times, lending grows and corporate finance activities surge. In recessions, their wealth division provides steady, fee-based revenue, while digital banking maintains leaner operations. In volatile markets, a strong balance sheet, conservative lending, and diversified income protect against sharp downturns. Conclusion: the investment case for Bank of America. Bank of America stands as a resilient, adaptive, and highly profitable financial institution. Its digital edge, diversified income sources, and strong capital base make it a superior long-term holding, especially in a high-rate, tech-driven banking environment. The combination of defensive strength and strategic offensive growth is rare, and that's precisely what makes Bank of America not just a bank, but an investment cornerstone. Coca-Cola, KO. Business Overview. Deep Dive. Global leadership in non-alcoholic beverages. Coca-Cola stands as the undisputed leader in the global non-alcoholic beverage industry. Its empire spans more than 200 brands, including iconic products like Coca-Cola, Sprite, Fanta, Minute Maid, Powerade, Dasani, and Costa Coffee, distributed across 200-plus countries. This immense scale gives Coca-Cola an unparalleled international footprint. Adaptive and category-expanding business model. Traditionally known for sugary sodas, Coca-Cola has aggressively diversified its portfolio to align with modern health-conscious consumer preferences. Ready-to-drink coffee via brands like Costa Coffee. Sports and energy drinks such as Powerade and Body Armor. Premium bottled water through Dasani, Smart Water, and Topo Chico. These new categories are not only expanding the TAM, total addressable market, but are also growing at double-digit rates, especially non-carbonated beverages, 15% YOY growth, which now contribute to 30% plus of portfolio revenue. Why CO's stock is a top choice. Deep financial insight. 1. Warren Buffett's favorite. Endorsement of quality. Coca-Cola is one of Warren Buffett's most celebrated long-term holdings. Originally acquired for under $1.3 billion, his KO stake is now worth over $25 billion. His investment philosophy is rooted in durability of brand, consistent cash flow generation, pricing power during inflation. KO checks all these boxes. 2. Strong pricing power and operating margins. KO has managed to raise prices by 8% annually, even during high inflation periods, without significant drop in volume sold. This is the essence of pricing power, the ability to pass on costs to consumers without losing market share. As a result, the company maintains operating margins above 30%, an outstanding figure in the consumer goods sector, where average margins typically range from 10% to 20%. This operational efficiency shows how brand equity, global distribution, supply chain mastery translate directly into profitability. Economic moat and strategic positioning. 1. Vast distribution network, barrier to entry. KO reaches over 25 million retail outlets globally, a feat few companies can replicate. Its distribution is a competitive moat, allowing it to be everywhere, from rural grocery shops in India to high-end restaurants in New York. TUI marketing muscle. With an annual marketing spend exceeding $4 billion, Coca-Cola stays top of mind across generations and cultures. This brand reinforcement maintains customer loyalty, high consumer recall, brand prestige. No other beverage company can match this global media presence, not even Pepsi on a consistent scale. 3. Market share dominance. KO owns 45% plus of the global carbonated beverage market, a staggering number in any industry, especially a mature one. Furthermore, Coca-Cola products are present in over 80% of global food service locations, cementing its presence in dining, entertainment, and hospitality sectors. 4. Health-conscious shift. Responding to trends, KO's non-carbonated offerings are not only expanding, but also outpacing carbonated drinks in growth. This shift shows Coca-Cola's willingness to evolve without cannibalizing its legacy brands. Premium water alone drives $7+ billion in annual revenue, growing at double-digit rates, and this is a segment often overlooked by casual investors. Financial strength and shareholder value. Dividend aristocrat. 61 years of consecutive increases. Coca-Cola is among the most consistent dividend-paying stocks in the world. Dividend payout ratio, 75%. Healthy, well-covered, but generous. Free cash flow conversion above 95%. Almost all net income is converted into actual cash. This high FCF ensures sustainable dividend growth and flexibility for buybacks or reinvestment. High return on invested capital, ROIC. KO maintains an ROIC above 20%, meaning it generates 20 cents of profit for every dollar invested in its operations. This is a clear indicator of excellent capital efficiency. KO knows how to make money work. Brand value. $90+ billion. The Coca-Cola brand itself, not the assets or products, is valued at over $90 billion, placing it among the top 5 most valuable global brands. This intangible asset provides pricing leverage, distribution priority in retail, long-term customer loyalty. Conclusion: YCO remains an elite long-term investment. Timeless moat. KO's distribution, brand loyalty, and global reach remain unmatched. Adaptability. Proven ability to evolve beyond sodas into coffee, sports drinks, and health-conscious products. Financial engine. Superior cash generation, high margins, growing dividends, and Buffett-level capital discipline. Resiliency. Performs well across economic cycles. Recession or inflation, Coca-Cola endures. Shareholder alignment. 61 years of dividend hikes show commitment to rewarding investors. In one line, Coca-Cola, KO, is not just a beverage company. It's a global cash flow machine powered by brand loyalty, distribution dominance, and an evolving product mix tailored to changing global tastes. Apple, AAPL, Business Overview. Apple Inc. is no longer just a hardware company. It has metamorphosed into a global technology ecosystem, a vertically integrated powerhouse that commands dominance across devices, software, and services. This transformation has allowed Apple to build an enduring competitive moat and deliver exceptional returns to shareholders. 1. From devices to ecosystem. Apple's foundation lies in its iconic hardware products: iPhone, Mac, iPad, Apple Watch, and AirPods. But its brilliance is in how these devices are interconnected through a seamless user experience, locking users into an ecosystem that combines aesthetics, functionality, and exclusivity. iPhone, the flagship product, accounting for the largest revenue share, remains the core of the Apple universe. It acts as the gateway through which users access Apple's services and other products. Mac and iPad. With the rise of hybrid work and creative professionals, Apple's MacBooks and iPads cater to both productivity and entertainment. Powered by Apple Silicon M1, M2 chips, delivering industry-leading performance per watt. Wearables, Watch, AirPods. Now growing faster than any legacy tech product line, this segment alone generates more revenue than most Fortune 500 companies. It enhances ecosystem stickiness by extending the Apple experience to health, fitness, and audio. 2. The services powerhouse. Apple's services segment, including iCloud, Apple Music, Apple Pay, Apple Care, and the App Store, now represents over 25% of total revenue and continues to grow at double-digit rates annually. Unlike hardware, Services offer high predictability, scalability, and margins. High margins. With gross margins exceeding 70%, Apple's services business is vastly more profitable than its hardware products. Recurring revenue model. Over 1 billion paid subscriptions ensure stable, recurring cash flows, decoupling the company's future from the cyclical nature of hardware refresh cycles. App Store, a digital toll booth for millions of developers globally, earning a commission on every app sale, subscription, or in-app purchase. Gross margins exceed 80%, a digital goldmine. Why Apple, AAPL, is a top long-term investment choice. Apple's appeal to long-term investors lies in its blend of technological excellence, economic moats, consistent capital allocation, and conservative financial management. Here's how. 1. Brand loyalty and switching costs. Apple enjoys unmatched customer loyalty. The iPhone's retention rate exceeds 90%, meaning once a user enters the Apple ecosystem, it becomes economically and psychologically difficult to leave. High switching costs. Apple devices and services are tightly integrated. Leaving means giving up iMessage, AirDrop, Apple Watch compatibility, iCloud Sync, and more. This ecosystem entraps users without them feeling trapped. The essence of a consumer tech moat. Premium pricing power. Apple commands average selling prices, ASP, 50% higher than Android competitors, despite offering similar specifications on paper. This is a result of the perceived value, design, security, and user experience. 2. Cash generation and shareholder returns. Apple is a cash machine, generating over $100 billion in free cash flow annually. It converts its revenues into profits at a rate few other companies can match. Capital Return Program. Apple has returned over $600 billion to shareholders via buybacks and dividends, making it the largest capital return program in corporate history. Buybacks. The company has reduced its outstanding shares by roughly 25%, enhancing earnings per share, EPS, and shareholder value without changing the underlying business. Dividend growth. Though the dividend yield is modest, Apple has increased its dividend at a double-digit CAGR for more than a decade, showing financial discipline and long-term commitment. 3. Financial fortress. Balance sheet. Strength. Apple holds over $150 billion in cash and marketable securities, giving it optionality to invest, acquire, or withstand macroeconomic shocks. Low debt burden. Though Apple issues debt for capital efficiency, its net cash position remains enviable. It has more than enough cash to cover all obligations multiple times over. 4. Strategic growth vectors. Innovation beyond iPhones. Apple isn't resting on its laurels. It is laying the foundation for multiple future growth avenues, each with enormous market potential. A. Wearables. 20% plus annual growth rate. Apple Watch dominates the global smartwatch market, and AirPods control a major chunk of the wireless earbud space. Collectively, the wearables segment already generates more revenue than most Fortune 500 companies, yet still represents a fraction of Apple's TAM. B. Artificial intelligence, AI. Apple has begun embedding AI at the core of its ecosystem, focusing on-device intelligence to differentiate from cloud-centric models like Google or Amazon. AI enhances user experience via personalization, voice control, Siri, photo curation, predictive text, and more, while preserving user privacy, a major Apple selling point. C. Augmented reality, AR and Vision Pro. The launch of Apple Vision Pro, a spatial computing headset, signals Apple's ambitions in AR/VR. Apple is taking a long-term platform approach, similar to the iPhone, planting seeds for the next user interface revolution beyond touchscreens. D. Electric vehicles, EVs. And mobility, rumored. While still unconfirmed, Apple's Project Titan suggests the company may eventually enter the EV or autonomous mobility market. Apple's design-first philosophy, software-hardware integration, and ability to scale could allow it to reinvent the car, as it did with phones and music players. I5. Profitability and market leadership. Operating margins. Apple consistently maintains 30% plus operating margins, far above industry averages, demonstrating efficient cost control and pricing power. Smartphone dominance. In North America, Apple holds about 50% market share in the premium smartphone segment, dominating the most lucrative slice of the market. Global device base. With over 2 billion active devices, Apple holds a rare position to distribute new services, updates, and experiences at scale. Conclusion. Why Apple is a long-term compounder. Apple is not just a tech company. It's a consumer trust brand, a recurring revenue platform, a financial fortress, and an innovation engine. While its iPhone may be the heart, its long-term health depends on a combination of wide economic moats, ecosystem, brand, switching costs, predictable and growing cash flows, services, wearables, strategic capital allocation, buybacks plus dividends, emerging moonshot ventures, AI, AR, EVs. Apple exemplifies Warren Buffett's ideal investment. A high-quality business with durable competitive advantages, high return on capital, and strong management, all available at a reasonable valuation during pullbacks. It remains a top-tier compounder for patient, long-term investors seeking wealth creation through innovation-powered stability. Occidental Petroleum, OXY. Deep explanatory overview. 1. Business model and strategic positioning. Occidental Petroleum is not just another oil company. It is an integrated energy enterprise that straddles three major sectors: oil and gas exploration and production, E&P. Its core business involves the extraction of crude oil and natural gas, with prime operations in the Permian Basin, one of the most prolific oil-producing regions globally. What makes Occidental unique is its technical and operational efficiency in this region, where it achieves approximately 40% lower production costs than the industry average. Chemical manufacturing, OxyChem. Occidental owns a major chemical division, OxyChem, which produces chlor-alkali products and vinyl's essential ingredients for everything from water treatment to electronics. This non-cyclical business provides a diversified income stream that cushions the volatility typical of oil markets. Carbon management solutions. The most forward-looking part of OXY's strategy is its carbon management business. With over $5 billion committed to direct air capture, DAC facilities, it is positioning itself as a pioneer in sustainable hydrocarbon production, capable of turning traditional oil production into a net zero or even carbon-negative activity. 2. Leadership and Buffett's confidence. Warren Buffett, through Berkshire Hathaway, has taken a significant ownership stake, now exceeding 25%, in Occidental. This is not merely a passive investment. It signals a strong endorsement of Occidental's management, financial discipline, and strategic vision. Buffett is known for investing in businesses that combine strong free cash flow generation, durable competitive advantages, disciplined capital allocation, predictable long-term value creation. Occidental ticks all of these boxes. 3. Financial strength and capital efficiency. Free cash flow, FCF. At current oil prices, OXY is generating more than $3 billion in free cash flow per quarter. This surplus capital supports aggressive share repurchases, targeting about 15% of market cap annually, growing dividend payouts, further debt reduction and strategic reinvestments, debt reduction and balance sheet optimization. Since 2020, the company has cut net debt by over 50%, transforming its balance sheet and gaining more financial agility in a volatile commodity environment. Return on capital employed, IROC. With a ROCE consistently north of 20%, Occidental demonstrates exceptional capital efficiency, putting every dollar to productive use. Operating margins. OXY boasts operating margins above 30%, significantly higher than most upstream oil and gas peers. This suggests strong operational control, cost leadership, and superior resource management. 4. Competitive advantages in energy transition. Carbon capture and direct air capture, DAC. Occidental is one of the few major energy companies investing heavily in DAC technology. These facilities aim to extract CO2 directly from the atmosphere, which supports carbon-neutral or negative operations, allows OXY to sell carbon credits, and potentially open new revenue streams in regulated carbon markets. Enhanced oil recovery, EOR. OXY uses CO2 injection not only to store carbon, but also to boost oil recovery from mature wells. These enhanced methods yield 25% higher recovery rates, reduce the carbon intensity of oil extraction by 20% compared to conventional drilling. Projected carbon business revenue? By 2027, the carbon management segment alone is expected to generate over $1 billion annually, transforming OXY from a pure oil player into a climate-aligned energy innovator. 5. Resilience in commodity cycles. Oil prices are notoriously volatile, yet OXY demonstrates resilience and flexibility. Break-even oil price. The company operates profitably even at oil prices below $40 per barrel, a remarkably low threshold that provides insulation against oil price crashes. Lowest quartile operating costs. Occidental is positioned in the lowest quartile of global producers, giving it a margin of safety and enabling continued profitability even during downturns. Why OXY stock is a top choice. Summarized. Strong endorsement by Warren Buffett. A 25% plus stake signals high conviction in Occidental's management, strategic vision, and long-term cash generation ability. Exceptional cost efficiency. Operating with 40% lower costs in the Permian Basin and break-even oil prices under $40 makes OXY one of the most financially resilient producers. Robust free cash flow and capital returns. Over $3 billion quarterly, FCF supports significant dividends, aggressive share buybacks, 15% of market cap, and rapid deleveraging. Diversified business model. OxyChem adds stability, while carbon management introduces high-potential, future-proof revenue streams. Carbon leadership in a greening world. $5 billion invested in direct air capture and enhanced oil recovery strengthens OXY's ESG positioning and unlocks new income opportunities. Superior return metrics. 30% operating margins and 20% ROCE indicate high operational efficiency and strategic clarity. Resilience across market cycles. With low-cost structures and diversified operations, OXY remains profitable and adaptive even in bearish commodity environments. Moral key takeaways. 1. Energy leadership today requires both profitability and sustainability. OXY is executing both through oil production and carbon capture. 2. Buffett's investment signals long-term confidence, not short-term speculation. 3. Operational excellence and capital efficiency set OXY apart from peers. 4. Carbon management is no longer optional. It is a strategic asset, and OXY is monetizing it earlier than most. 5. Low-cost producers survive and thrive during oil downturns. OXY's break-even price gives it unmatched resilience. 6. Diversification. Chemicals, carbon, E&P, provides financial stability and strategic flexibility. 7. OXY is not just an oil company. It's evolving into a future-ready energy solutions provider. Moody's Corporation, MCO. Deep explanatory overview. 1. Business overview. The architecture of a global risk intelligence powerhouse. Moody's Corporation is one of the most respected and entrenched institutions in the financial world. It operates at the core of the global capital markets, serving as both a gatekeeper of credit risk and a provider of sophisticated analytical tools used by investors, banks, insurers, asset managers, and governments worldwide. Moody's operates through two primary segments. A. Moody's Investors Service, MIS. The credit ratings arm. This is Moody's traditional business assigning credit ratings to debt issuers like corporations, sovereign nations, and structured finance instruments, e.g., mortgage-backed securities. MIS is one of the big three rating agencies globally, alongside S&P Global and Fitch, collectively controlling over 95% of the market. Moody's alone commands around 32% global market share. The strength of this segment lies in its oligopolistic market structure, which forms a significant economic moat due to high regulatory barriers. Credit ratings are deeply embedded in financial regulations worldwide. Trust-based brand. Investors, regulators, and institutions rely heavily on Moody's reputation and historical data integrity. Network effects. Issuers want ratings from agencies. Investors trust. Investors want ratings from agencies with robust, time-tested methodologies. B. Moody's Analytics, MA, the growth engine. This segment has evolved rapidly in recent years and now contributes over 30% of total revenue. It provides risk modeling software, quantitative credit assessment tools, regulatory and compliance platforms, climate and ESG, environmental, social, governance, analytics. MA operates largely on a software-as-a-service, SaaS, and subscription-based model, offering high recurring revenues. Over 90% contract renewal rates, double-digit annual growth in contract value. MA represents Moody's pivot from being purely a rating agency to becoming a comprehensive data-driven risk intelligence platform for the 21st century. 2. Why MCO stock is a top investment choice. Buffett grade quality. A. Durable competitive advantage. Economic moat. Oligopoly in credit ratings. Just 3 firms dominate a sector with enormous global regulatory dependence. Entering this space requires decades of trust, data, and regulatory approval, a nearly impenetrable barrier. Brand credibility. Moody's name has been synonymous with risk transparency for over a century. Analytics ecosystem. Their analytics offerings are deeply integrated into clients' internal operations, increasing switching costs. This combination of regulatory embedding, brand trust, data scale, and client integration creates a fortress-like economic moat, something Warren Buffett repeatedly emphasizes in his investing philosophy. B. Exceptional profitability metrics. Operating margins near 50%. This implies for every $1 of revenue, nearly 50 cents remains after operating expenses, a rare level of efficiency. Return on equity, ROE, between 70–80% indicates superior capital allocation. Moody's converts equity capital into profits at a pace few companies can match. Free cash flow conversion above 75%. A key Buffett metric, it shows Moody's can turn its accounting profits into real spendable cash. This supports dividends, reinvestments, and aggressive buybacks. C. Powerful revenue mix and recurrence. Analytics division's recurring model. Subscription-based revenue allows predictability and insulation from macro shocks. Contract renewal rates 90%. Indicates deep entrenchment in client operations. Customers don't just use Moody's, they depend on it. Average contract value rising double digits. Demonstrates both pricing power and increasing value delivered to clients. D. Secular tailwinds in ESG and risk. 35% plus YoY growth in ESG-related revenue. As sustainability becomes a regulatory and investor priority, Moody's tools are in increasing demand. $2.5 billion pipeline in analytics contracts, a future growth indicator. Moody's is not just maintaining its revenue base, it is expanding its addressable market. Asset-light business model. Unlike industrial or retail firms, Moody's doesn't require significant capital to grow. This translates to higher return on invested capital, ROIC, greater flexibility in deploying free cash, strong balance sheet with low capex needs. 3. Strategic acquisitions and innovation, reinforcing the moat. Moody's has made targeted acquisitions in climate risk analytics, e.g. RMS 427, cyber risk modeling, private company data platforms. These allow Moody's to stay ahead of evolving regulatory frameworks, meet rising investor demand for non-financial risk metrics, create cross-selling opportunities across its client base. By integrating ESG, climate, and cyber risk into their core offerings, Moody's ensures its tools remain indispensable to modern financial decision-making. 4. Capital allocation, excellence. Buffett admires firms that don't waste cash on vanity projects, maintain disciplined share buyback programs, pay sustainable and growing dividends. Moody's checks all these boxes. Share repurchases. Reducing share count increases EPS and shareholder ownership percentage. Steady dividend growth, supported by reliable cash flow. Reinvestment in high ROI segments, especially in analytics, ESG, and regulatory tech. Moral key takeaways. 1. Moody's operates in an oligopolistic industry with high regulatory barriers, giving it a wide, durable economic moat. 2. Its core credit ratings business generates extremely high margins, driven by brand trust and data scale. 3. Moody's Analytics segment is the future-facing engine, offering sticky recurring revenue via subscription models. 4. Massive tailwinds in ESG, climate, and regulatory risk analytics ensure sustained multi-year growth. 5. Outstanding capital efficiency and cash flow generation support both innovation and shareholder returns. 6. Asset-light business model with strong pricing power keeps margins and returns among the highest in the S&P 500. 7. Moody's embodies Buffett's investment principles: predictability, moat, return on capital, and honest capital allocation. 8. Strategic acquisitions enhance capabilities in emerging risk domains, future-proofing the business. Bottom line, why these 5 stocks stand out in 2025. If you're aiming to build long-term wealth the Buffett way, these 5 Berkshire Hathaway holdings deserve a serious look. Each company reflects Warren Buffett's core investing ideals: durable competitive advantages, smart and steady leadership, and strong, reliable cash flow. Bank of America brings financial resilience and digital innovation to the table. Apple continues to rule the tech world with its unmatched ecosystem and brand loyalty. Coca-Cola offers timeless brand power and global reach. Occidental Petroleum is carving a future in both traditional energy and low-carbon innovation. Moody's anchors itself in the heart of financial markets with essential risk analytics and credit ratings. Together, they form a diversified, high-quality portfolio built on Buffett's timeless principles of value investing. While the future always holds some uncertainty, these companies are well-positioned to keep delivering solid, sustainable returns over the long haul. If you're thinking like Buffett in 2025, these aren't just stocks. They're long-term partners in your journey to financial growth.